Hello, I'm Nick Finkenauer, a tax director at McGowan Hearst Clark & Smith. Today's topic of discussion is entity selection, a hot button issue in the tax world since the Tax Cuts and Jobs Act was signed into law in December of 2017. The tax definition of entity selection is choosing how your business entity is taxed. The first reason this is such a hot topic is because of the reduction in the corporate tax rate. Pre-2018 rules applied a maximum rate of 35%. The Tax Cuts and Jobs Act has now implemented a flat 21% rate. The second reason is because of the Qualified Business Income Deduction, or QBI deduction, which is a 20% haircut on qualifying pass-through business income. Because of the new 21% rate, pass-through businesses need to think about whether it makes sense to switch to a C corporation. Pass-through businesses are taxed on their income at the individual level, with the maximum rate being 37%. Now you may see 37% and compare that to the 21% C corporation rate and say, well, the decision is obvious, but that couldn't be further from the truth. Using a quick example, say a C corporation has $1 million of taxable income. The federal tax on this would be $210,000. Then, if they paid out the remaining $790,000 as a dividend, the individual shareholder would pay an additional $188,000 of tax, assuming they are in the top tax bracket. If you have heard the term double taxation, this is where it comes into play. This means that the total tax is $398,000, which is an effective tax rate of 39.8%. Now, assume the business is organized as an S corporation and the business is eligible for the QBI deduction. This means the shareholder pays tax on $800,000 since they received the 20% QBI haircut. Assuming the top individual tax rate of 37%, the tax becomes $296,000, which is a 29.6% effective tax rate. It should be noted that dividends or distributions are not taxed in a pass-through business. Obviously, this is lower than the C corporation effective tax rate of 39.8%, but there are many factors that go into this, including how much the C corporation pays out as a dividend, whether the business is eligible for the QBI deduction, the long-term plans for the business, and what the taxable income of the shareholders is. There are many scenarios where it could be beneficial to become a C corporation, so it all depends on your facts and circumstances. Be sure to check out our YouTube channel for other valuable topics to view, learn, and share. If you have questions, please give us a call, drop us an email, or stop by, and we are happy to help. Thanks.